Here's part 3 of our chapter 9 video lecture. This should be the last part for chapter 9. So in previous videos, we've learned how to fill out this Schedule E for rental property. So let's assume that the amount of rent we've collected for the year is less than the total expenses we have for the year, resulting in a loss. But for the loss to be deductible, we have to pass a couple different tests reported on these two different forms. The first one is called the at-risk rules or limitations. And the second one is called passive loss limitations. And we applied the at-risk rules first and then the passive loss rules second. For most people, they don't have a problem with the at-risk rules and they don't have to probably fill in this form 6198. Just like the term implies, you're at risk of losing money. So if you have a loss, are you really economically losing money versus just having a paper loss? Typically, a paper loss can happen if you have a non-cash expense like depreciation. So for most people, they would borrow the money to buy the property, and whatever cost went into the property, they get to deduct a depreciation expense, a paper deduction. But let's say that when you borrowed the money, you really weren't personally liable. The lender would just foreclose on the property, take it back to help pay off the loan. And if there was anything still due, the lender didn't hold you personally responsible for that. That type of borrowing, that type of lending is called non-recourse. If you borrow money and have to pay it back no matter what, even after they foreclose on the property, that's called a recourse loan. But if you don't have to be personally liable on anything after the property is foreclosed, that's a non-recourse loan. And at most you can deduct is the amount of money you put in and the potential money that you're personally liable for, or whatever is at risk. So for most of us, when we borrow money, the lender is not going to say, oh, you don't have to pay it back if you cannot pay everything off after we foreclose. Yeah, they're going to force us to sign off your life and your children. Yeah, they're going to make you sign off on a recourse loan. So everything's at risk. So again, for most people, they don't have to worry about this form 6198. Sometimes when you hear non-recourse borrowing or lending in terms of investing, that's typically related to the term tax shelter, yeah, or abusive tax shelter at times. Let's move on to the second limitation, which is on this form 8582, dealing with passive activities. Of course, again, income is always taxable, but losses are usually not deductible unless it's allowed by the law. So if you run a rental loss and you are really passive, laying back and not doing anything to earn that money, or in this case, a loss, the government says that you only can deduct any losses to the extent of any income, passive income you have. Okay? Passive losses can only be deducted to the extent of passive income you have for that same year. So to be able to apply this rule, you have to classify your income each year into 3 different categories. So let's take a look at what our textbook says here. This is beginning on page 12 or here on page 13. There's 3 different types of income. The first category is called active income, and that is made up of work income like wages or your salary, or like we learned in 2 chapters ago in chapter 7, on our Schedule C, we've had trade or business income. Basically, we're working. Basically, we're putting in our labor to make money. And that's the active income or active profit. Another category of income is called portfolio, basically coming from an investment portfolio that's generating dividends and interest income. Or maybe when you sell those investments, it's just generating capital gains. That's called, again, portfolio income. And then the third type of income that we're dealing with here in this chapter 9 is passive income, which for most people, they still consider it to be investments, but it's really a business they're investing in. So let's say that you have a business, but you don't work in it. Here they say you don't materially participate working in that business. Like basically all you're doing is investing in that business, almost like a creditor lending money. Maybe you have, let's say, a brother who's makes surfboards and he needs some working capital, some money. So you lend him the money and now you're almost like a partner in a partnership, but you don't do any work. And any profit you make is passive income, or any losses you incur is a passive loss. Here's what we're dealing with here in chapter 9: rental activities. By definition, a rental activity is classified as passive. A rental loss, like we're dealing with now, is considered to be a passive loss. Or if a little bit more formally, if you invest in a limited partnerships, any loss generated by that partnership that's passed through to the partners by default is considered to be a passive loss. And all of these activities here under passive, if you have a loss, you only can deduct it that year if you have passive income for that year. Any losses that you cannot deduct in the current year for passive activities will be carried over to next year to offset any passive income for that next year. And again, subject to the same limitations. If you cannot deduct it, you carry it over to the following year. And if for continuing years you don't generate any passive income to deduct your passive losses, you still get to deduct the loss, but only in the year you get rid of that passive investment that releases the losses that you couldn't claim before. They call it suspended losses. So again, the amount of loss that you have for the year is probably here in the previous line, and the amount you get to deduct is going to be here now in line 22, coming from this form 8582. So let's take a look at that form 8582. Okay, passive activity. We get to deduct passive losses to the extent of passive income for that year. So we divide up this passive activities into 3 different categories. This first one is possibly the most common, or the one we're dealing with right now, where we have rental real estate. So here in line 1 is where our activities have a profit. And here in line 1B is when those activities, again, rental activities, have a loss. And here in line C, if we couldn't use any rental losses in the previous year, now we can try deduct them this year to offset any of the income we may have. So when you combine all 3 together, here is the amount of net passive income or loss from rental activities during the year. The second category here in line 2, I really haven't seen any. I think I've dealt with a developer that made this type of property, but not an owner-operator, and not too common, so let's ignore this line 2. But in line 3, the typical stuff you put here in line 3 would be those limited partnership income and losses. Again, in line A would be the income items. Line B would be the loss items. Line C would be losses from prior years that you couldn't deduct. Again, you net out all of these here to get a net income or loss from other passive activities. And if one is an income and one is a loss, you can offset each other to get a net income or net loss over here. And again, if you end up with losses here, possibly you cannot deduct all of the losses because they exceed the amount of income you've have reported up here, passive income. So let's say that you have a kind of some income and some losses here. Yeah, some income and some losses. If you end up with a loss here and the main loss is attributable to rental real estate, you may be able to claim a deduction for part of it. Here, this so-called special allowance for rental real estate. Again, you've already netted out the income, yeah, against your losses. But if you still have excess rental losses, up to 25,000 more losses can be deducted. But this amount here will be phased out if your taxpayers' taxable income exceeds, I think it's AGI income exceeds 150,000. If it's below 100,000, there's no limit. Well, this would be the limit, the 25. But if you exceed 150, it'll zero out the amount that's deductible here. So for every $2 you go over the 100,000, you're going to reduce this 25,000 by $1. Yeah, because the range here is 50 and the deduction here is 25. So that's one of the limits here, figuring out the amount of additional amount of rental real estate losses you can deduct. Eventually totaling it up, everything over here, and then going back to the Schedule E and filling in here the amount of the deductible loss versus here the amount of the gross loss for the year. So let's take a look at an example in our textbook how to calculate that passive loss limitation. Let's go to page 21 here. So we're given this information for Kurt and Heather Redding. And we're filling in, let's see, I think it's back on page 18. Yeah, this is Derek Smart. The other one was for the qualified business deduction. We're given information about their losses. Just coincidentally, their rental real estate loss is that limit of 25. Yeah, they should have used another number in the example so to confuse us, but we'll see not all of this will be deductible. And they have some other passive activities generating a profit of 10,000. So definitely we know we can use up to 10,000 of this loss to offset 10,000 of this income. But then because this loss is generated by rental real estate, we may be able to deduct up to 25,000 additional losses subject to their adjusted gross income amount. And here we're told the AGI amount over here, yeah? That may, because it's over 100,000, they're going to be limited. So let's take a look at the form of how all of these numbers are plugged in and the calculated losses figured out. So here in the rental real estate, we don't have any income, but we do have that loss of 25. So when we combine everything together, we end up with a rental loss of 25. And then for the other passive activities, typically, again, the main type of losses that would fall here would be coming from limited partnership investments. In our case, we have partnership income, limited partnership income. So here is the income. And when you combine the two together, here is the excess loss. So we are able to use $10,000 of the loss up here to offset this income. But again, because we have an excess loss that's generated by rental real estate, and not from any loss over here for other passive activities, we may be able to claim more of the loss using this special allowance. So we plug in here the loss. Looks like we use a positive number now. And here's that limit. If we go over, we get nothing more. Here's our taxpayers' AGI. So they have about 18,000 more before they get totally phased out. Again, because of the 2-for-1 rate, we use this 50% amount. So 9,000 more of the loss can be utilized of this extra 15. So the total loss you're going to be claiming is this 10,000 offsetting the passive income and this 9,000 more for this special allowance. So the total loss is going to be deductible is going to be 19,000. So when you take a look at the Schedule E, we came all the way down here to this $25,000 loss, but again, not all of it is going to be deductible. We had figured out on this form 8582 that 19,000 is deductible. Yeah, eventually that's what you see down here at the bottom of the Schedule E. So what happens to the difference here of 6,000 loss? Well, next year, when we do this passive loss limitation form, right here, we're going to put the prior year unused losses of $6,000 to offset any rental real estate or other passive income. Yeah. Again, and if we cannot use it this year or future years, eventually any unused losses will be deductible in the year we dispose of the property that's creating the losses. Let's cover one more topic here in Chapter 9, and then that's the qualified business income deduction. So if you remember back a couple chapters ago, back in Chapter 7, the last part of that chapter, the last video for that chapter talked about a 20% qualified business income deduction. It doesn't cost any money. You're not spending money to get this deduction, but you're looking at the business's qualified income and you're multiplying it by 20% to get the amount you can subtract on your tax return. And it's not treated as a business expense, right? It's treated as a number we put kind of close to the itemized deduction or standard deduction on the Form 1040. But to be able to claim this deduction, you gotta have business income. If your business has a loss, there is no QBI deduction. Now, our textbook here in this short paragraph kind of makes it seem simple that landlords can claim this deduction. That's not technically true because rental properties is not generally treated as a trade or business. The term we use for rental property is called production of income, a production of income activity. Even though the landlord may spend a lot of time with their properties, they're not considered to be so-called active income or materially participating. But now for this qualified business income deduction, the IRS has come out recently with a procedure. They call it a revenue procedure. And if the landlord can have records showing they spent up to 250 hours or more during the year on their rental business, they can treat this property to make it qualified business income property. Again, you have to have a net income to be able to claim this deduction. And these hours here can include anybody you hire to work on the property. It could be a contractor. You can count their hours to meet this limit. You also have to have good record keeping. You cannot just run your business off the backside of an envelope. You should have a good accounting system keeping track of your business income and deductions. Okay, that's it for this chapter. If you need to know more about QBI, take a look again at that video back for chapter number 7, the last video for that semester. If you have questions, you know where to contact me.